So, Amy, Lori Calvasina over at your shop just upgraded to 50-50 for next year for the S&P because this year the stocks just ran so hard. How are investors positioned to take advantage of the next 6 weeks and then set up into 2022?
Hey, Alex. Yeah, when we look into that, obviously another part of Lori's call that's interesting is kind of just the continuation of the value trade as well. When we look to the derivatives markets, I would say the one thing that's very clear is option markets are not worried. And that's becoming a larger and larger disconnect from the bond markets. You see that volatility in the bond markets, you're not seeing in the equity markets, and you're not seeing people hedge. And what I think is even more interesting than that is when you look at value versus tech, there's also no distinction there. So it's not like people are more worried about tech than they are about value. It's kind of fairly bullish all the way through, which is quite interesting in the face of the inflation risks that we see.
So, Amy, are they not hedging? Are investors not hedging because it's so expensive to hedge, or are they not hedging because they're not that concerned?
Yeah, it's a great question. And actually, the relative expensiveness of hedging right now is not that high. Guy, it's going to sound a little strange, but part of what's contributing to this bizarre dynamic we're seeing in options right now is continued retail call buying in names like Tesla, Amazon, GME. The reason I say that is, if you look to Bloomberg's MEMB, these are really heavyweights in an IWM or a QQQs. So if you continue to get bullish demand there, it ends up bleeding into the ETF levels. So, you see this over demand for calls and you see the puts as relatively less expensive. So it's a little bit of both.
Okay, so where do you want to be buying then cheap puts?
Look, I think the risk right now, obviously, as rates rise, there's kind of still a period where equities continue to outperform. I think the risk is actually the pacing, right? If the Fed has somehow screwed up, if you per Dudley's comments this morning, and the pacing is off, then you can see these sharp swings of volatility. So we always think about the world in terms of tails. Where is the tail attractive right now? The tails are very attractive in both IWM and QQQs in terms of owning that tail if downside does occur. And then the other one that I like is retail XRT into the holiday season, which again has not been that expensive. You can really comfortably sell upside now with all these things at highs and fully fund those downside protection levels.
What do you make of what is, you brought it up at the beginning, what do you make of what is happening in equity volatility versus bond market volatility? Bond market volatility really starting to pick up. The market's all over the place. Equity markets not so much. Just talk to me about how you see that being resolved.
Yeah, not to sound like a harbinger, but unfortunately, when you look to the past, that tends to resolve itself by equities following bonds, if you actually kind of look at the correlations over the past. And so, that gives me a little bit of nervousness. And it's one of the reasons why I've been telling investors that when these tails to the downside look inexpensive and you have one part of the market saying something different than the other part, then, it's a time to kind of consider those hedges when they haven't become kind of overblown, because typically, the options market can react two ways. When things continue to go up, you can start to see demand for downside go up, and that has not happened right now.
So, Amy, are retail investors still as heavily involved in the market as they were, say, 12 months ago? And I ask that because I wonder if that changes the calculus of how we're used to thinking about like the next 6 weeks in the market.
Yeah, the short answer is yes. And it's become really interesting because you always have to factor this in particular on a stock like Tesla or something like that. But and they only seem to like buying call options. It's kind of interesting. Like I don't know why there is that skew, but that is something that we've had to factor in, and that, as I mentioned before, is starting to bleed into your ETF levels because a Tesla is such a heavyweight, for instance, in a XLY, and the same thing for a GameStop and IWM. So you have to factor that in, and then the other thing that is related to that is these upside momentum swings can go on for longer than you typically would have them because of the fact that it continues to exist.
What's the relationship with crypto and meme stocks right now?
But, everything we talk about for inflation and the risks ahead, is a good thing for crypto, right? If you think about, what people are going to look to hedge and kind of maybe trading out of a gold or your traditional hedges into crypto, it's a very similar cohort from, what I can tell, who is investing both in equity call options on these meme names as well as crypto. I think, when we talked to the head of risk strategies at Coinbase, Gustavo Miguel, one factor that he pointed out for next year, in the second half of next year, will be the merge. So essentially the change in protocol in Ethereum, that'll be a big catalyst to watch. And then near term is actually taxes. The fact that, people who've made a lot of money in crypto through yen are probably going to have a tax bill to watch out for.
In terms of, I guess what I'm also trying to understand is, as crypto does well, does that mean that the call buying in equities is well supported? If you remove one leg of the stool, does the other one become impacted? Because previously, if crypto fell out of bed, there was definitely an impact into some of these meme stocks. Crypto's doing relatively well at the moment. You've got this inflation narrative. Does that continue to support the meme stock buying, particularly on the call front?
I think on the retail side, I think that does make sense. If you're doing well, you're making money. Just bring it back to one person, right? You're a person who trades crypto. You're doing well. You have the ability to fund the retail call buying as well. I think that's part of it. But the larger story is there's also just more institutional adoption in crypto, and so I think it's kind of more difficult to suss that out. I will tell you, when we've looked at correlations in the past, there actually tends to be an inverse correlation in some of the meme stocks, like a GameStop and an AMC, compared to Bitcoin and Ethereum, which, I don't know how that holds up over longer periods of time, because there just simply isn't that data yet, but we've actually seen a negative correlation there in the past.